Good afternoon, everybody. Welcome to today's webinar regarding a detailed review of the One Big Beautiful Bill Act. My name is Spencer Bunn. I'm a certified public accountant based out of Phoenix, Arizona, and a principal with the firm Karpinski, Bernstein, and Adler PLC. And I will be giving today's presentation to all of you. So thank you so much for coming. I will mention to you that this session is being recorded. I will be providing a link to the recording probably sometime shortly after the new year next week, and we'll circulate that once I am able to put that together and make it available for everybody. So the purpose of today's webinar is to dive into the One Big Beautiful Bill Act that was passed earlier this summer by President Trump and by the US Congress. We're going to go over some of the changes in tax law, both things that were enhanced or modified, as well as some new additions to tax law. During this session, everybody is both muted and not on camera. However, I will note that both the chat and the Q&A features are fully available. I do anticipate that some of my time today will be for Q&A. I figure based on the material I put together, I'll probably be actually presenting for anywhere from an hour to an hour 15, which will leave the last 45 to 60 minutes for Q&A. So as you have questions during today's session, please leave them in the chat or Q&A. When I am done with my presentation, I will go through as many of those as time permits. I'm hoping to get through all of your questions, and I hope that I've left enough time to do so. So with that, I'm going to go ahead and we're going to dive in. For those of you that do have chat access, any issue hearing me, just give me a thumbs up. Everybody, are we good? Nothing wrong? Just a couple of you can reply and then let me know. Okay, thank you, Ed. Okay. All right, looks like we're good. I got some positive feedback. Okay, so we are going to dive right in. So first, let me begin with this disclaimer, and I'll go ahead and just read this verbatim off of my slide. So the information presented in this slideshow is for general educational tax purposes. One specific tax situation or circumstances may materially influence whether one qualifies or is eligible for the tax benefits contained herein. For specific tax advice, you can engage me directly to consult with you, or you can seek out your own tax advisor, whether that person be a tax attorney, certified public accountant, enrolled agent, or other tax professional. So with that, as I mentioned before, I did set up both the chat and the Q&A. So just a rehash on that. If you have questions during the session, please leave them there. I anticipate at the end of this meeting going through all of the questions that you have. Okay, so first I'm going to start with a general summary of the One Big Beautiful Bill Act. So this was passed in July of 2025, so about 6 months ago, by President Trump. It went through Congress. And as I mentioned previously, many of these changes to tax law are either enhancements or maybe bringing something back that was there before. There also are some new provisions, and today's presentation focuses on a lot of the highlights, things that are going to have at least some relevance with a lot of people's either individual or business tax situations. So with that, we are going to dive right in. So the first thing we're going to talk about is the child tax credit. And on most of these slides, to the extent that there were provisions that were previously in tax law that have been enhanced, I have kind of a before and after comparison to what this looks like. So child tax credit, been around forever. In its most recent iteration as of the 2024 tax year, this was something where if you have a kid, they're under age 17, and your income is within the appropriate limits, you get a credit on your federal tax return of $2,000. And for kids ages 18 to 23 who are either in end of high school or during college, it's a reduced credit of $500, and that's been the law for the last 7, 8 years. The numbers have been different, but child tax credit's been around for many decades. The new law introduced two changes to it. One, which we haven't seen before with the child tax credit, which is that going forward, it's going to be an inflation adjusted credit. It has always been a credit where the amount has been fixed in law, and then it just sits at a fixed amount until such time that Congress decides to change it. There have been a couple of times in the past where they have. Now it's going to start at a new baseline. The new baseline is $2,200 for kids under age 17. The income limits haven't changed. And now that it's inflation adjusted, it's going to go up, figure 2 to 3% a year on average. It's about how much things go up when it's inflation adjusted. So at the level it's at, $50 a year, give or take, is what you're going to see with this child tax credit going forward. All right, so this was a significant change. So the state and local tax deduction, this is something, you see this if you itemize your deductions. If you take the standard deduction, you don't see this at all. This was one of the more, when this was first introduced with Trump's initial tax bill in his first term, it was one of the more controversial changes. This was a deduction that as of 8, 9 years ago, you could deduct however much in the way of state income tax, property tax, vehicle registration that you had. The Tax Cuts and Jobs Act, which was first passed at the end of 2017, limited this deduction for all taxpayers, regardless of income level or anything. It capped it at $10,000. It caused a lot of waves, especially in higher tax states, because this tax deduction was seen as more of an indirect subsidy to people living in those states. This new legislation releases the pressure on this a little bit. It increases the cap for people that are under $500,000. So cap's been 10 grand since 2018. Now the cap will go as high as 40,000. Although if your income exceeds $500,000, it starts to claw back down to 10 grand. And by the time you reach 600,000 in income, you're back at a 10 grand cap. So knowing my client demographic and those of you on this call, this will, to the extent that those of you itemize, this will probably have a positive benefit for a good number of you that are, I would say, in that $100,000 to $500,000 income range, and you itemize your deductions. This is definitely going to make a difference on your 2025 tax return. Okay, so next we have estate taxes. So the way estate taxes were scheduled to change, absent any change in the One Big Beautiful Bill, is that they were on a trajectory whereby if nothing changed this year, the exemption meaning this is the amount of money that you can pass tax-free to heirs. This year, the exemption is $13,990,000. Let's just call it 14 million. It was set to drop to anywhere between about $6 to $7 million next year, depending on how inflation adjustments were going to work. So it was going to drop basically in half, absent any change in the law. This new law puts the limit at 15 million effective for 2026. And then that 15 million will continue from here to infinity, be indexed to inflation. The inflation adjustments on the estate tax over the last decade plus have typically been in the neighborhood of a few $100,000 a year is what it amounts to. So at 15 million, you're probably looking at maybe 300-400 grand a year of adjustments to that total. And this is I should stress here, this is a per person total. So if you're a married couple, this amount is doubled. So next year, a married couple, if they, God forbid, both passed away at the same time, they could pass up to 30 million to their heirs without any estate taxes. Okay, so this is a new change, and I want to stress with this new senior deduction, this was the compromise that Congress put in, there was, of course, a lot of discussion, a lot of political banter about, okay, we want to make Social Security tax-free. I think it's a crime that it's not. You pay into it your whole life and then you get taxed when you get it. Whatever. So there was a lot of discussion about making this tax-free. Eventually, the compromise that was reached was, okay, Social Security is still going to be taxed the way it has been in the past, which is where a part or up to 85% of it is subject to tax, depending on your level of income. However, Congress did introduce this new senior deduction. And basically, the way this deduction works, it's income limited. So if you're a senior being defined as age 65 and up, and your income is less than $75,000, or if you happen to be married, $150,000, then you get a $6,000 deduction off of your income. And this is a per person deduction. So if you have a married couple, you're both over age 65 and you're within the appropriate income limits, you get $6,000 apiece or $12,000 between the two spouses. Once income exceeds $75,000 or $150,000, as the case may be, this credit slowly phases out. You basically lose, for every $100 your income goes up above those caps, you lose $6 of the deduction. So after another $100,000 of extra income, so once a single person hits 175 or once a married couple hits 250, this deduction disappears entirely. So if you're above those income thresholds, unfortunately, this deduction won't be available. If you're below those thresholds, this will be a new deduction. Hasn't been in place before. This is something that is straight out of the ether. So for those of you in my among my clients that are, many of you are retired or at the end of your working careers, this is something that some, if not a good number of you, will probably benefit from this year. And all other things being equal, it will make a positive impact on your 2025 tax return. Okay, so another new provision, and this one I'm going to walk through a little bit because there's some wrinkles to it. So vehicle loan interest, I want to stress here, this is for a personal vehicle purchase. It says nothing, if you're a business owner, you buy business vehicles, nothing changes there. Everything related to deducting like a business vehicle, everything like that, or depreciating it. I'm going to talk about some of the depreciation provisions that have changed here in a few minutes. So this is for, you buy a car for yourself, you go to the grocery store, you run your kids around, whatever you do. There was a new deduction that was added to the tax code that allows, in certain circumstances, and I'm going to walk through them here in a moment, that allow for the deduction of vehicle loan interest. This is a deduction that is available both regardless of whether you itemize or not. So standard deduction, people can claim this deduction as well. So here are the provisions of this new deduction in the code. First of all, it's only available for the next 4 years. So 25 tax year, 26, 27, 28, absent any extension or any other changes by Congress, this disappears at the end of 2028. So for the purchase of a new car, and new, not just new to you, but new period, like the original use of the car begins with you, you're allowed to deduct on your tax return up to $10,000 of vehicle loan interest paid, assuming that you financed the purchase and are paying on a loan. So up to $10,000 is deducted. This is an income limited deduction. So if you are $100,000 or under, or if you're married $200,000 or over or under, this is fully available to you. Once you get over those caps, this deduction slowly phases out until, I don't remember the exact top of where this phases out completely, but I want to say somewhere in the neighborhood of maybe 125, 150 if you're single, double that if you're married, that this deduction goes away entirely. So for those of you who are going to be working with me to do your 2025 tax returns in the next couple of months, if you bought and financed a new car, I don't care what your income level is, go ahead and provide me that information. The IRS will be, they didn't say they're going to do it for 25, but they are going to create a new Form 1098. It'll be something akin to what you get for your mortgage every year that they're going to report this on. You're probably not going to see this for 2025 because the IRS didn't develop this form for this particular calendar year. But what I anticipate is that lenders through whom you have a new vehicle loan are probably going to give you some kind of an informal letter that says, dear taxpayer, you bought a car through us last year, or you financed a car through us last year, and the interest you paid was X. Have a nice day. So whatever information you get in that regard, or maybe it's just your December loan statement from the bank or lender, I'll definitely want to capture that information. If your income's too high, your income's too high, but I would rather you put that on the table with me than not. That way we can at least determine whether it is something to be taken into account. All right, so this next one, this is looking ahead a little bit, but I wanted to put it on the table because this is going to be relevant, not for this current calendar year that's about to close, but it will definitely be relevant in 2027, so a little over a year from now. So Congress created in this new law basically a new category of charities called scholarship organizations. So basically these are already established 501c3 charities that devote so much, and the law defines how much, that devote so much of their resources to providing college scholarships. And I'm guessing at this point because a lot of this is still being fleshed out, but this law will probably cover, say, existing like college foundations, things where they're giving a lot of their resources to scholarships for kids to participate or to join or to go to school at a particular university. So as of right now, the IRS just released some guidance on this a few weeks ago that provides some additional standards for how certain charities that think they might qualify for this, how they basically become certified to be one of these charities. And effectively, the way this is a tax credit actually, how this is going to work is that if you give money to one of these scholarship organization charities, then you will be allowed to claim on your tax return a credit, not a deduction, but a credit. So a dollar for dollar reduction of your tax of up to $1,700. Now, as I mentioned before, since this is not in effect this year or even next year, there are still parts of this that are being fleshed out. It's unclear. Okay, the $1,700 credit, is that double for a married couple? That part is unclear. At this point, there isn't a group of, there's not like a bona fide list of charities that are qualified that one can look to. If this credit works as intended, what is going to happen is there's going to be a public list of qualifying charities that the IRS vets, approves, whatever. It's going to be published online, and then people can seek out those charities, donate to them to their heart's content. The first 1,700 of that donation would be eligible for a tax credit. There is, on this particular kind of donation, there are no income limits at all. So you can make $100 million, you sold your business, whatever, and this is still something that would be available to you. Again, since this is very new and it's not going to be something in effect this year or even next year, there are still details that are being figured out. As more details become available on this, I suspect it'll probably be, and I'm guessing here, next summer, where we will probably learn more about the charities that are going to qualify for this, and maybe some additional things about how the mechanics of this particular credit are going to work. But this is something looking ahead just over a year from now, for those of you who like to donate money to various charities or charitable causes. These are charities, many of which already exist, that based on the standards the new law established for being able to be a qualifying charity in this new bucket, many existing charities are going to find, oh my gosh, like I already meet the standards here. This is a way for us to raise additional money because people can get an extra tax benefit if they do so. So now this is a vehicle through which that can be done. Okay, so this next one, you guys aren't going to like me, but don't shoot me on the messenger. Fortunately, this doesn't start this year, but it does start next year. Most of you are probably familiar with the concept of with medical or dental or vision expenses. They're very hard to deduct because the law establishes a very high floor, 7.5% of your income, that you have to clear before you can even deduct those expenses. So if you made $100,000, you have to have minimum 7,500 of medical expenses before you can even deduct the first dollar. And that's assuming you itemize. If you don't itemize, then of course there's no medical expense deduction at all. Congress introduced that same, it's not quite as steep, but for those of you who donate and for those of you who are higher income, this is going to be a little bit of a haircut. They introduced a similar floor beginning next calendar year for charitable contributions. So this charitable floor or this income floor works similarly to the medical expense floor. It's at a lower threshold. It's only 0.5% of one's income as opposed to 7.5%. But that is going to make a little bit of a difference. So let me walk you through a hypothetical example, and then you'll understand how that would work. Let's say your adjusted gross income is $300,000 for the year, and you made donations to charity of $10,000 to one or more charities during the year. As the law stands right now, assuming you can itemize your deductions, you get the full $10,000. The income limit on donations, which is going to continue with this new law, is 60% of one's income, which is a ceiling that few, if any, taxpayers ever reach. It's normally only in a year where maybe you lost money that you would ever reach that ceiling. For anybody making any reasonable amount of money, it's an extraordinary amount of donations that it would take to get to that level. So going back to my hypothetical, you donate $10,000, you made 300. This calendar year, no problem. You're going to deduct the full 10 grand. Next calendar year, 2026, same income, same donations. Okay, you have 10 grand that you contributed. We now claw back 0.5% of your income. 0.5% of 300 grand is 1,500. So we reduced the 10 grand deduction by $1,500, and now your deduction is $8,500 as opposed to $10,000. Of course, the higher your income goes, this is a percentage floor. So if your income's $500,000, 0.5%, $2,500. If your income's $1 million, 0.5% is $5,000. So this has the potential to claw back a decent amount of charitable donations. The one point I put it here at the bottom, for those of my clients who are in their 70s, 80s, 90s, taking required minimum distributions from your IRAs and other retirement accounts, this new charitable floor is going to enhance the benefit of taking what is known, and I've talked to many of you about it before, about taking a qualified charitable distribution out of your IRA. This is a tax benefit. It's only available to people who are above age 70 and a half and are currently taking required minimum distributions. For those for that particular group of taxpayers, they're allowed to, as part of their required minimum distribution every year, directly from their IRA or other retirement account, contribute that amount to charity, and it counts against their minimum distribution, but it doesn't get added to their income. There's no 0.5% cap with that type of donation like there would be with any other kind of donation that you would itemize. So this only enhances the benefit of contributing through that means rather than the way you would normally think to contribute. Okay, so staying on the topic of charitable contributions, Congress introduced, and they had previously introduced this during COVID, although it only lasted for a couple of years. They introduced a limited deduction with this new law where if you don't itemize your deductions at all, usually you can't take charity if you don't itemize. Congress introduced a limited deduction that would allow people who only claim the standard deduction to be able to deduct some level of charitable contributions. Under COVID, from what I remember, this was a few years back, I think the limits were $300 if you were single, $600 if you were married. It was a very low level. It's a little higher now. So if you take the standard deduction, you're now able to claim $1,000 on top of your standard deduction, or if you're married, $2,000 off of your income taxes for donations that you make. So this is going to be, for those of you that claim standard deduction, I'm going to be, unlike in the past where I probably wouldn't care as much about what your charity was. If you take the standard deduction, now it's going to matter at least a little bit. So these deductions aren't huge. For a married couple, if you take the full $2,000, maybe shaves a few $100 off the top, but that's better than nothing. So this will be something that I'll probably ask for, that for those that are taking standard deduction, I haven't really asked for in the past unless you volunteered it to me. So I should also point out this new standard deduction add-on for charitable contributions. There is no, unlike the last slide, I talked about the 0.5% income limitation. There is no such cap with this one. If you're a standard deduction, or if you claim the standard deduction and you donate $1,000, you get to deduct $1,000. Or if you're married, you donate $2,000, you get to deduct $2,000. All right, so this next one, this is a kind of transitioning here into some of the business tax changes, or at least one of them. Bonus depreciation. So this is a provision. It's been in the law on and off, dating back to the early 2000s. It's a provision whereby if you're a business owner and you buy new equipment, new machinery, new vehicles, new, fixed assets for your company, bonus depreciation allowed you to take or deduct a certain percentage of that upfront. And these percentages have been in various places over the years. Most recently, before this law was passed, the level of bonus depreciation was at 40%. It was actually on a sliding scale out the door. Under the Tax Cuts and Jobs Act that was passed in Trump's first term a few years ago, bonus depreciation was put at 100%, but only through the end of 2022. And then beginning in 2023 and continuing each of the next 5 years, it was going to scale back 20%. So in 2023, it went down to 80%. 2024, it went down to 60%. Earlier this year, it was down to 40%. And then assuming things continued on that track with no law change, it would have gone down to 20% next year and then disappeared entirely in 2027. This new law restores the ability to deduct, using bonus depreciation, 100% of new asset purchases. The nice thing with bonus depreciation when compared to Section 179, which we're going to talk about in just a moment, is that bonus depreciation is allowed to create a loss. Meaning, let's say, for example, again, hypothetical, you have a business, your net income before we take into account new asset purchases, your net income is 200 grand in your business, and you bought 280,000 of new equipment. With bonus depreciation under this new law, we can deduct all 280 grand of those new asset purchases against your 200 of net income. And now we can create an $80,000 loss by taking depreciation in such manner. And assuming you have the basis to deduct that loss, you've now created a loss for your tax return if this is a partnership or S Corp, or we've created a loss inside of a C corporation. So So that is bonus depreciation. All right, so section 179, this is a close cousin to bonus depreciation. There are, unlike with bonus, you can take bonus on as many assets as you want. There's no income limits, purchase limits, anything like that. Section 179 is another separate provision in law that also allows us to claim the full amount of a new equipment, new machinery purchase and deducted in year one as depreciation, although there are some limits on this. One is an income limit. So going back to my prior hypothetical, you have net income of 200 grand, you buy 280 grand of equipment. Using section 179, you could deduct 200 grand of those purchases, bringing your income to zero. The remaining 80 grand of depreciation deduction would get suspended and carried over. Under the new section 179, they did increase the limits. They were previously, you could take it on up to $1,250,000 of new asset purchases, provided overall purchases were less than $3,130,000. They've raised those levels beginning in 2025. Those new levels are, we can take section 179 on up to $2.5 million of asset purchases, provided that overall purchases are less than $4 million. Okay, so this, I'm going to stress with this one because I know many of you, especially those who are running businesses, you're about to do your 1099s for the 2025 calendar year. This is a change that will impact when you do your 1099s next year for 2026. So this is not going to change what you're about to do in the coming weeks as you issue 1099s to your service vendors. So as background on this, businesses have long been, at least as long as I've been in business, probably far longer, have been required to issue 1099s to their service vendors, generally speaking, if payments to said vendors exceed $600. And that $600 limit has been in place at least as long as I've been practicing, probably far longer. It's been a fixed amount in the law, never been updated for nothing. And Congress eventually came around and said, okay, this limit is a bit dated and antiquated, and we're going to give it a bit of a modern refresh. And so the way the modern refresh works is twofold, kind of the same thing with what we talked about earlier on the child tax credit. The new minimum threshold for reporting a 1099, again, this is beginning next year when you do your 1099s for 2026 and early 2027. The new threshold is not $600 anymore. Now it is $2,000. So it gets just over a 3x bump from where it was before. The other thing they changed here, again, like the child tax credit, this is a limit that is now going to be indexed to inflation. So every year, this $2,000 is going to go up 20, 30, 40, $50, and the limit's going to get progressively higher, progressively higher, progressively higher as the years go on. And so, from a 1099 reporting standpoint, this will definitely, all other things being equal, probably reduce the 1099 reporting burden, because now you're going to have a lot of smaller people. Maybe they did one or two small things for you. You paid them $1,000, $1,200, $1,500. And now those payments, which would currently be reported under the current standard, which is in effect at least through tomorrow, are not going to be reportable under the new standard that takes effect next year. So this will be a significant change that will, all other things being equal, reduce your overall 1099 burden. And going forward, the limit is going to go up a little bit every year going forward. All right, so tip income. This is an interesting one, and I got a follow-up slide on this to go over at least some of the quote-unquote qualifying professions. So prior law, tip income treated like any other source of income, pretty much. You earn it from work, and it's wage income, business income, right? I mean, it's always been taxable income. There's been nothing really special from a tip income standpoint compared to anything else. And now there was this new provision introduced where tips that are earned from specific professions, I'm going to get into a partial list on the next couple of slides. But now tips are going to be effectively tax-free with some caveats. So the way the law works, and this takes effect, I should stress, this takes effect for 2025. So for those of you that work in industries where you get tips, whether you are, you know, maybe you're driving Uber, you work in a restaurant, whatever it is that you're doing where you're earning tips, and there's already, for different reasons, a tip line on a W-2. So this should be something that is already going to be captured in your W-2, probably has been captured in the past, although it didn't really have relevance to the person earning it. It did in many cases to the business paying it, which is why it has had a separate line. But now it's going to have relevance to the people earning it. And so the way this new deduction works is that you receive a deduction on your return up to the level of your tip income, not to exceed $25,000. And this is a per person limit. So if you have a married couple and they both work, let's say they're waiter and waitress at the same restaurant, and they make buckets of tips, they could each deduct up to 25 grand. So it'd be 50 grand combined as a potential deduction against their income. This is an income limited deduction. So if your income is over 150 grand, or if you're over 300 grand if married, this 25 grand deduction, or whatever your tips are if less, begins to get clawed back. Didn't put the amount at which this would completely disappear, but after about, I want to say maybe 200, 250 if you're single, maybe double that if you're married, this deduction would disappear entirely. I do have, if you guys want to take note of it, a link, and I'm going to go through some of these here in just a moment. I have a link on my bottom bullet point if you want to either take a picture or copy that into your browser. I'll leave it up for a minute. This is a complete list of all of the professions from which one can receive eligible tip income. One of the fears the IRS had when this legislation came out is that, oh, great, now we've created an exclusion for tip income, and so now everybody and their mother is going to say, well, I have tip income, even though they would be in I'm a lawyer and I got tip income, and I'm an insurance agent and I have tip income. So the IRS wanted to put a bit of a lid on that, and so they established regulations which in so many words say, okay, in order for this deduction to be obtainable, you have to be in one of the eligible professions. And they broke it out into certain categories. I'm going to get into that in just a moment. And it's only if you're in one of these buckets do you qualify. I will note as we get into one of these buckets, there's one, I found it kind of an eye-opener because the individuals in this profession I wouldn't think of as ones that I would normally tip if I'm using them for myself, to say nothing of the fact that they're professions that are, the one that I found eye-opening are ones that are normally pretty well compensated. And again, I wouldn't normally associate tips with what they do, but here we go. So these are the different categories. Some of these are kind of obvious, so I'll just kind of walk through these. So beverage and food, so, bartenders, wait staff, chefs and cook servers, very common. Like, I don't think there's any surprises with that. No real surprise with this next one either. Entertainment events. So people who work at casinos, dancers and musicians, maybe these are like street performers, or maybe ushers. Again, no real surprise with those. And then we have hospitality and guest services. That includes, bellhops, concierges, maids. Again, pretty common to see tips here. Here's the eye-opening one. And the IRS, they put it in black and white. Home services. So I normally wouldn't think to tip these people. Maybe I should. But handymen, painters, landscapers, electricians, plumbers, HVAC, pool, locksmiths. the IRS put all of these professions on paper and said these are eligible tip professions. So, of course, all of my tradespeople right now are probably finding their pom poms from high school and waving them around. But yeah, that is a category the IRS expressly laid out in their regs. These are some of the more common ones in that category that I listed here. So yeah, that's one of the categories. Continuing down the list, personal services. So this could be a butler, wedding planners, photographers, videographers, pet groomers, tutors, babysitters. Continuing down, so personal appearance and wellness. So masseuses, beauticians, hairdressers, manicurists and pedicurists, makeup artists, personal trainers, tattoo artists. No real surprises with any of those. Recreation and instruction. So this can be golf caddies or teachers, piano teachers, recreational pilots, tour guides, sports instructors of different types, diving, skiing, tennis, surfing, swimming, blah, 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 blah. And then the last one, transportation and delivery. So people who are valets, cab drivers, shuttle drivers, delivery drivers, vehicle cleaners, home movers. Could probably add to that like Uber and Lyft, people who are running around people through those services. So there's your new tip income deduction in a nutshell. All right, so another brand new deduction, and then I have an important caveat on this, which is going to upset some of my business clients, but the IRS basically gave businesses the finger this year, and I'm going to get into that part in a moment. But in addition to the tip income exclusion, there's now been created a new deduction for overtime pay. So overtime pay being defined, you're an hourly wage worker, the hours that you work for which you get paid time and a half, generally speaking, that pay is now subject to be deducted and removed from taxation on your tax return. So this is a temporary law. It starts 2025. It ends at the end of 2028. So it's only got a 4-year window on it unless Congress decides that they're going to change it in some fashion. So the deduction is on overtime pay, you can deduct up to $12,500 per taxpayer. So, or 25 grand if married. Again, it's a per taxpayer limit for overtime pay that you received from your employment during a given tax year. Like the tip income deduction, this one has the same income limits. If you're single, you have to be 150 grand of income or under, or married 300 grand or under to be able to benefit from this deduction. If you're over those limits, the deduction starts to phase out. Once you reach about 200, 250 individually, this deduction goes away. About double that if you're married, this deduction goes away. Now here's the caveat with this. I'm hoping this is just a 2025 problem. So when this law passed in July, normally what happens, especially when there's a law that passes that impacts the present year, like in this case, this bill, the IRS typically, especially when it creates logistical challenges with how things get reported or captured, the IRS immediately goes to work and they will begin updating the way that certain tax forms appear. Indeed, with this one, for example, they've already created an additional schedule that will be part of your 1040 that will report how this deduction is claimed on your tax return. One set of tax forms, however, where they did not update this, and they basically said in their guidance, they basically threw up the bird and said, you know what, we're not going to do it, and you guys kind of have to figure it out on your own. So in both payroll tax returns as well as W-2s, and the W-2 is the more important piece here because for those of you who are business owners, you're about to give W-2s to your employees in the coming weeks. And so this is going to be a really important thing. Two things happen with this, at least for 2025. The IRS is like, we're not creating, and they say this in guidance. I'll even email it to you if you don't believe me, but they said in so many words, We're not creating space to report this on payroll tax returns for 2025 or on W-2s. Furthermore, and this is the part that's wild to me, we are not going to require businesses that they have to put this on their W-2s. So like they could just blow this off if they want. And for a taxpayer who's in that boat, if they get a W-2 and there's no breakout of their overtime, their IRS basically said, well, they're left to their own devices. They can look at pay stubs. They can kind of finagle their overtime pay some way or another, but like we're not going to make it the employer's problem, which I just think is completely crazy. Let me tell you what we're doing in my business, and I would encourage you guys to duplicate this. For our hourly employees, so W-2s have long had a box on it. It's box 14, and it's kind of a miscellaneous catch-all box for any of 1,000 different things that an employer wants to report there. There's no real criteria for what gets reported in that box. Again, employers can put all kinds of miscellaneous things that aren't captured by other boxes on a W-2 in that particular box. Now, our overtime pay through our payroll provider, and I suspect this is true with most payroll providers, our payroll provider already captures that data, right? Like if I go to my payroll provider and I pull reports on my hourly employees for 2025, I can easily see through their prior reporting how much of their pay this year has been regular 40-hour-a-week pay and how much of their pay has been overtime pay. And so what we asked our payroll provider to do with our W-2s in our company, and for those of you who run businesses, I would encourage you to do the same, is we asked them to utilize this catch-all box 14 on the W-2. And we said, hey, you guys already have our overtime pay data. You're already accumulating it anyway. We want you to take those numbers for the employees who have it, throw it in box 14 and put some kind of acronym, OTP, something like that, that will designate that pay so that those employees know what that pay is and can then claim that deduction on their return. I found the idea of like not telling those employees what that pay is and leaving them to their own devices to just be underhanded. So for those of you who do have W-2s, I would encourage you to connect with your payroll providers, ask them, hey, do you already have this info accumulated? They very well might. And if they do, ask them, hey, I want, for each employee that has overtime pay, please report it on box 14 of my employees' W-2s. If for no other reason, that they now readily will have that information available. And then when they go to file their tax return, if their W-2 says, let's say 50 grand of wages, and then in box 14 it says OTP $6,000, they're going to report their 50 grand of wages. Separate from that, they'll report a $6,000 tax deduction for their overtime pay. So that's my one thing on overtime pay. If you run a business, you have employees, please, since the IRS, and they're not going to make you do it, I can't even make you do it. I would encourage you, though, for their benefit, if nothing else, if you could find a way to give that information to them, or even if you don't give it to them on their W-2, even if you just separately send your employees an email and say, hey, we went back through our records and your overtime pay last year was X, and give this to your tax preparer. Or if they do it themselves, they can include that in their own return. However you want to give them that data, there's, again, no real format for it. I think a W-2 is the easiest way to do it, but even if it's just going to be, you slip them a note or an email, like that's okay too. I hope that next year they'll get off their duff, create some additional lines or boxes or whatever on these forms so that this will be something that is reported no differently than, say, one's 401k contributions on a W-2 or one's HSA contributions or dependent care benefits or any of 100 different things that already have designated spots on a W-2 that can easily be captured. My hope is that they're going to create something like that. They just haven't done so yet. And again, kind of flipped everybody off this year and said, we don't care. So that is the new overtime deduction. All right, so last slide today. So this is an enhancement of qualified opportunity zones. Let me walk through uh, what this tax benefit is. This one's kind of complicated, and now Congress has, with a few tweaks, has basically extended it into eternity. This was a new provision of tax law that was created with the Tax Cuts and Jobs Act back in 2018. And basically, what Congress wanted to do is they wanted to create an incentive where underdeveloped or more economically depressed areas of the country could receive economic investment, and people would build real estate, whatever, in these areas, and they wanted to incentivize this. So what they did is they created this complicated tax benefit, which in short, we just call them qualified opportunity zones. So the way these work in general is that you're allowed. So a qualified opportunity zone is where you invest in a business that is, in most cases it's building real estate, but it can also be that they have equipment in one of these designated areas. Are designated by each state as kind of, more rural or underdeveloped areas. And so if you invest in a business or in a fund that is building real estate in one of these areas, there are a couple of tax benefits related to it. The first is that you're allowed, to the extent you contribute to one of these funds, you're allowed to defer capital gains. You can't delay them forever. So this was a popular tool where if somebody had maybe a one-time large gain on sale of stock, for example, or maybe they sold their business, they had a large gain on the sale of their business. Let's say somebody had $1 million of capital gain. In lieu of recognizing their capital gain for that given tax year, they would instead invest this $1 million into a business that is building or developing something in this qualified opportunity zone. And under the prior provisions of this law, the way this would work is that when you made this contribution, you would defer your gain until the end of 2026. So in a little over a year, those who have invested in these in the past are all going to have tax bills come due from whatever gains they originally plowed into these. The second and more significant tax benefit of these, although it's a little bit more future looking, is that, and I'm generalizing here, but if you invest in one of these and you hold your investment for at least a decade, so 10 years, if you sit on this investment for at least a decade, then when you go to sell that investment, the sale of that investment, any appreciation in your original investment is entirely tax-free. So by way of example, under the prior way that this worked, you have $1 million gain, let's say in, I don't know, 2021. You decide, well, I don't want to pay $1 million capital gain this year, or tax on $1 million capital gain. I'm going to invest into one of these qualified opportunity zones. So you invest in one, you delay the tax on the $1 million until what is now next calendar year, 2026. So April of 27 is when that tax bill will come due on the million that you invested. And then if you hold that investment for 10 years, so at least through 2031, 2032, whenever 10 years would be reached, after that point, if you sell the investment, let's say at that point the investment is now worth $2.5 million, just to pick a number. You sell that investment for 2.5. Normally your gain would be $1.5 million. You invested $1 million in it. It went up to 2.5. You have $1.5 million of gain. Well, if you hold it 10 years, the gain wipes out, goes away. So the enhancement to this law, or the way this law now works, is if you have large capital gains and you want to defer them or delay them, and you do so by investing in one of these, the way the enhancement of this now works is that you get a 5-year deferral on the gain. So you punt the gain 5 years out. And then, similar to before, you have to hold the excuse me, you have to hold the investment 10 years. And if you hold the investment for 10 years, at that point in time, if you decide to sell after that period of time, the investment becomes completely tax-free. Um, I know some financial advisors, they have people who go into these. I don't talk about these too much in my practice, in part because the investments are complicated. I mean, these are something where, the main tax benefit is very forward looking. It's 10 years out. I'm not saying it's a bad tax benefit, it's a very good one, but there comes with these a lot of investment risk. You're putting money into something, these areas that where they're incentivizing development in many cases are economically depressed for a reason. And so, you go into these with a lot of investment risk, and just because there's this tax pot of gold at the end of this rainbow doesn't mean that the investment's going to pan out. It could be, a flop or a bad project, and the tax benefit isn't going to mean so much. So yeah, this is something where, if you have huge capital gains, and usually by huge, I'm thinking bare minimum 100 grand. I mean, ideally probably 250 or more, which is not going to be a whole lot of you. But if you have those one-off years where you have these huge capital gains, this is something that you can consider. It gives you time to punt the gain. It's an investment, which if it pays off is a home run from a tax standpoint. But yeah, there's definitely more considerations than go into this than just, oh, I'm gonna do this and save a buck for a few years on my gain. Well, if it's a bad investment, then just keep your gain, pay the tax. So yeah, there definitely is some due diligence that goes into this. You want to make a good investment. Who are you going in with? What are they doing? What's their track record? So on and so forth. So that is qualified opportunity zones. Oh, I forgot I had one more slide. So energy tax incentives, many of them as of tomorrow, and some as of a few months ago, these are going away. So these have everything. So I'm not going to hit all of them here, but like the main ones that you guys would have benefited from. So like the solar tax credit you put on solar panels on your roof or solar battery, um, energy efficient home improvements. So you put in like energy efficient windows, energy efficient doors, energy efficient roof, energy efficient HVAC. There were different tax credits for those different categories. Or if you bought like an electric or hybrid vehicle, there were vehicle tax credits relating to a lot of those things. Depending on the vehicle, it could be as much as $7,500. All of those as of tomorrow, you can kiss them goodbye. They are all going away. There's some others I didn't put up here that are a little bit more niche. But yeah, and anything energy related that you can think of. So solar panels, energy efficient improvements, electric cars, hybrid cars. As of tomorrow, these all go away. I would anticipate, this is my guess, that since these credits acted in a way, especially when it came to like solar and electric vehicles, since these in a way were kind of a subsidy to the people creating them, I would anticipate, and I could be wrong, that the prices of these are probably going to adjust down for the fact that the credits are no longer there. Because like say if you're a solar panel installer, solar panel manufacturer, and now people don't have the carrot of a 30% tax credit anymore, it's only going to be natural that those providers are now going to say, okay, well, yesterday a thing that cost 50 grand, now it's 40. Like, I mean, they're going to do what they can to bring their prices down so that they can hustle and keep their business up. So I suspect that even with that tax credit going away on some of these things, that there's going to be a bit of a market adjustment in these prices that will alleviate the blow. I could be wrong, but that's what I would anticipate there. All right, so I am going to pull up my questions and let's see what we got. All right, so question about qualified opportunity zones. Um, can someone use, I'll read the question verbatim and then I'll give the answer. Can someone use one of these investments to defer the recognition of gain from 2025 to 2026? I realize that someone would have had to anticipate this to be able to use the strategy for 2025, but could it could it be a planning opportunity for future years? So yes, if you do have capital gain in 25, yes, you could invest in a qualified opportunity zone. And yes, you could take advantage of that tax benefit. I will note that the new rules whereby you get a 5-year deferral, that 5-year deferral doesn't start until investments are made in 2027. So you're not going to get, I mean, one of the tax benefits here is the deferral of gain. If you have a 2025 capital gain and you invested in a qualified opportunity zone, you're only getting 1 year of deferral on that gain as opposed to 5, or if you invested earlier on in the first iteration of this, maybe 6 or 7 years. So you're not getting quite the deferral. However, the benefit of a tax-free gain, if you hold it 10 plus years, that is, of course, still available. I would, for somebody considering going down that route where there's going to be a very limited deferral, I would encourage somebody in that situation to make sure they have, outside of whatever gain they've incurred that they're going to invest, that they have some liquid funds available that they're able to pay the tax a year from now. The last thing I would want to see is where they go into an investment and like that's most of their liquid money. They put in, let's say, $1 million, they have $1 million gain. Well, the bill on that's coming due in a year. If they don't have, say, 200 grand set aside to pay that tax, I mean, they're not going to get it out of the investment. Like that's a long-term investment. It's not like selling stock in the stock market. So you're going into something which is in most cases a real estate project. You're not getting your money out in a year. So for those people who are going to consider going down that road for 2025 and look to make a qualifying investment, my recommendation would be make sure that independent of however much you're going to put in, you have set aside in savings somewhere or in highly liquid money the ability to pay that tax in a year, because otherwise you're going to be completely cash strapped. You're going to get a 200 grand, hypothetically, 200 grand tax bill in a year, and you'll have nothing liquid. Like you'll be scrambling to sell, a piece of land or whatever it is to generate money to pay your tax. So yes, it is available. But I would say do so carefully if you're going to go down that route. All right, let's see. I don't see anything in the Q&A. Kelly, are you able to, I don't know if you can hear me. You able to see if anybody posted anything on your end? I'm not seeing anything on my end. Yeah, I'll leave things open for the next few minutes if you guys want to type in a question or two or 10 into the chat. Otherwise, I can conclude this a little bit early. So yeah, I'll give you a few minutes. I'll just watch the chat and the Q&A, and if anything comes up, I'll be happy to answer your questions for the next few minutes. Got a few thank yous, so thanks, guys. Give it a couple more minutes for any other questions if you guys want to type them in. Okay, so somebody mentioned I believe that solar credits are still available for businesses until the end of 2026. That may be the case. I know the rules on um, I know the rules or the rules that govern the tax credit or the solar tax credit for businesses are a little bit different than they are for individuals. You may be correct about that. I'll have to look at the law and confirm. Honestly, it's very rare that I have clients use the business tax credit or I'm sorry, the solar tax credit for their business. Um, 99.9% of the time when they're using it, they're throwing panels up on their house. So yeah, you might be correct about that. I'll have to go back and confirm. I'll go ahead. I'm going to make a note to send you a particular email on that issue. Okay. So, question about so it says estate computation accounting charges deductible. The answer is yes. So this goes both for so when we talk estates, this is both if you have more money than God and you're above the 14 or $15 million exclusion, and you're preparing an estate tax return. So any accounting charges to put everything together in the estate or the preparation of an estate tax return itself, those are all deductible fees. The same is true for, like in a simple example, okay, somebody passes away, they have an estate, you're managing it, and you're selling their old house, you're getting rid of their belongings, whatever, distributing things to beneficiaries. Same situation there. To the extent you have income, the costs of preparing that return, putting together an estate accounting, et cetera, yes, those are absolutely deductible. Okay, so question, do you expect AMT being alternative minimum tax, to creep back in with the tax law changes? I do not. The reason why I don't is that the changes to the law basically kept the way AMT is right now is the calculation is such where it rarely applies anymore. I could count, I do hundreds of tax returns a year. I could count on one hand the amount that have AMT, which is a far cry from, say, a decade ago when it would be several dozen in a year where I would have AMT. So the provisions in the law that provided for how AMT works, those were basically extended out into eternity with the new bill. I don't anticipate any major changes with that. There is, although I don't think it's going to be relevant for this audience, there is a corporate AMT, but that only applies at stupid high levels of income. I don't think that kicks in until like a company has, say, a billion with a B in like assets or income, which that's just not the demographic I serve. So, but yeah, I don't anticipate that to be a problem at all. I'll leave another minute or two for any other questions, and then I will wrap this up. All right, I'll give it one more minute and then we will close up shop. I'll move my slide to my contact info so you guys can see that. For anybody who might be on this that doesn't know who I am or might want to reach out and learn more. All right, so looks like that's it on the Q&A side. So wanted to thank everybody for your participation today. I will be, as I mentioned at the outset, I'll be saving a recording of this, putting it online along with the original slides. And thanks so much for your time today, and hope you all have a safe and happy new year. Have a great day, everyone.